Hi there, in this video I'm going to talk about notes receivable. First I will explain the difference between notes receivable and other receivables. Then I will talk about the journal entries for acceptance and collection of notes receivable that might happen in the same year or they might happen in two different years. And then we talk about honoring the notes receivable and dishonoring the notes receivable. So with this in mind, the notes receivable is different from accounts receivable because accounts receivable are mainly related to sales of goods and services, but notes receivable are mainly related to either sales or lending cash or extending the payment of the accounts receivable by issuing note receivable. There is also other receivables here like giving loans to the officers or advances to the employees, which are different from accounts and notes receivable. With this in mind, I'm going to talk about notes receivable only in this video. Here is a simple format of a note receivable, and you can look at the note receivable from two different sides. If you look from the payee or the beneficiary side, he considers it as a note receivable, which is a current asset. But if you look from the maker's side, it's a note payable, which is a current liability. In this video, I'm going to talk only about note receivable. So what are the journal entries for the note receivable if the acceptance and the collection journal, they happened within 1 year? First, when we accept the note, we debit note receivable and credit either cash or sales or accounts receivable. It depends on the situation. When we collect the note, we debit cash, credit note receivable, and credit interest revenue. So we calculate the interest at the collection time, not the acceptance time. When we calculate the interest, we multiply the face value times the annual interest rate times time. And the time here might be an issue because the interest could be computed based on annual or monthly or daily basis. We have no problem with the annual or the monthly, but when we come to days, we need to omit the date the note is issued and include the due date. And I put here a very brief example to show you how to calculate the interest based on the number of days. So here we have three different situations. One note of $20,000, 6%, but has time period of 3 months, and it was dated on April 20. What is the collection date or the maturity date and the maturity value? Another amount, 30,000, with an interest rate 8%, but here the maturity period is 72 days. So we count it here by days, and it is due on June 5. The third situation, 12,000, 9%, but it's 30 days, and it was issued on August 15. So how we do the first one? Because we calculate it based on monthly, we multiply the amount 20,000 times 6% times 3 over 12. And we get the maturity value 2,300. And of course, the maturity date is going to be July 20. But in the second situation, we need to count 72 days from June 5th. Remember here to omit the date of issuance, which is June 5th. So we count the difference between 30 and 5. In June, we get 25. In July, we get 31. If we add them, we get 56, but we need 72. So the remaining number of days, 16, is going to be in August. So the maturity date here will be August 16, and the maturity value will be 30,480. For the third situation, we talk about 30 days starting from August 15. So we have 16 days in August, and then 14 days in September. So the maturity date, the 14th of September, and the maturity value, 12,090. Now, how about the notes receivable journal entry if the acceptance and the collection fall in two different periods. So here we have the interest is split between the first year, where we counted as accrued interest, and interest revenue in the second year. So for the first journal, it's similar to the first situation we have it, where we debit notes receivable, credit cash sales, or accounts receivable. In the third journal, you will see here that we have two different accounts for the interest. Interest receivable, which counted for year one, interest revenue for year two. But for this situation, we use another journal that we haven't used it in the previous situation, where we debit interest revenue, credit interest receivable, credit interest revenue for the amount of interest that happened in year one. Let us look at the second exercise to show you how we calculate it. So here we have issuance of different notes. We need to journalize the issuance and the collection of the interest. The first note, it was 15,000 issued on November 1st for 1 year. So we debit notes receivable, credit cash by 15,000 on November 1st. The second one on December 11, we debit note receivable, credit sales. The third one on December 16, we debit note receivable, credit accounts receivable. The fourth one, we need to calculate the interest revenue for the three notes that happened during the year. So we need to count it for each one separately. The first one, it was for 60 days. The second one for 20 days. The third one for 15 days. We multiply it and we get 295. Then we debit interest receivable, credit interest revenue by the amount of interest only for year one. Now, the last point is the disposal of the note receivable. And here we might face two situations. Either the payee will pay the amount, so the maker pays it in full at the maturity date, and here we debit cash, credit note receivable, credit interest revenue, and interest receivable. Or the payee or the maker will dishonor his promise. In this case, if we expect to collect it later, we debit accounts receivable, credit note receivable, and interest revenue. If there is no expectation of collection, we put it in the allowance amount. I hope you get the key point from this quick video of how to journalize the acceptance and the collection of note receivable, and how to calculate the interest, whether the two dates fall in 1 year or 2 different years. Thank you.